Welcome, everyone. I am so thrilled to have you all here for today's Masterclass Explainer on the Enterprise Financial Reporting System. Go ahead, get settled in, pull out your notebooks. We're going to take our time today and really set a deliberate, focused pace. Because today we are unlocking the literal language of business. We'll be moving from those foundational, theoretical frameworks straight into practical, real-world applications. So by the time we wrap up, you won't just be staring blankly at a spreadsheet. You'll actually be able to read the financial story it's telling you.
Okay, so here's our game plan for today. We're going to cover the financial reporting system, the balance sheet, the income statement, the cash flow statement, the notes and relationships, and finally, we'll wrap up with some applied case studies. But before we really dive in, let's make sure we're all on the same page with our learning objectives. On the knowledge front, you're going to need to fundamentally understand the definitions, the structures, and how all these statements relate to each other. Skill-wise, you'll learn how to identify specific line items, verify accounting equations, and actually interpret this data to make real decisions. But I want you to pay extra close attention to this last one, attitude. When you are dealing with financial data, you absolutely must cultivate a mindset that is professional, careful, honest, and hyper-accurate. Analytical thinking is going to be your absolute best friend here. And precision, well, that's just non-negotiable.
All right, let's get into it. Section 1, the financial reporting system and its 4 components.
So, under Vietnamese accounting standards, specifically VAS 21, a complete set of enterprise financial statements is never just one single document. It actually requires 4 distinct, yet deeply interconnected components. Now, to really grasp the difference between the main two, I want you to think of the balance sheet, or Form B01, as a snapshot. It literally freezes the company's financial position at one exact split second in time, say midnight on December 31st. You are looking at a frozen photograph of exactly what they own and exactly what they owe. In total contrast, the income statement, Form B02, is a video. It records the flow of all revenues and expenses over a full accounting period, capturing every bit of the action from January 1st all the way to December 31st. Keep that analogy locked in your head as we move forward, okay? Snapshot versus video. Moving on to Section 2, the balance sheet, which reveals the company's statement of financial position. So why does this snapshot actually matter? Well, management uses it to figure out their solvency and capital structure. Investors rely on it before handing over their money. Creditors and banks, they check it to make sure loans can actually be repaid. And tax authorities use it to verify compliance. It is the ultimate corporate health check for a specific date. Now, listen closely. If you take absolutely nothing else away from today's lecture, I need you to memorize this basic accounting equation. Assets equal liabilities plus equity. Assets are what the business owns, liabilities are what the business owes to outsiders, and equity is what actually belongs to the owners. Because of the double entry bookkeeping principle, this equation is absolutely always balanced, no matter what the transaction is. It is the unbreakable law of accounting. Let's think about how the standard B01 structure is actually mapped out. On one side, we organize the assets. These are divided into current assets, things like cash and inventory that can be liquidated quickly, and non-current assets, which are your long-term fixed assets. Then, on the other side, we organize the financing sources. This includes liabilities, both current and non-current, and equity, which covers contributed capital and retained earnings. Let's put this into practice and break down the assets for Ho Bin Food Company. They've got a total of 6,000 million VND in total assets. Carefully notice how this is composed. They have 2,800 million in current assets, which breaks down into 500 million in cash, 800 million in receivables, and 1,200 million tied up in inventory, plus some other minor items. Down below that, they're holding 3,200 million in non-current assets, which is mostly fixed assets worth 2,800 million. So this tells us exactly where the company's value is parked, right at this moment. Now thinking about the other side of the equation for Hoa Bin, where exactly did the money come from to buy those 6,000 million in assets? Well, they have 3,200 million in liabilities and 2,800 million in equity. And look at that, the equation balances perfectly. Let's take a quick second for some math. If we divide their equity of 2,800 by the total assets of 6,000, we get an equity ratio of about 46.7%. As financial analysts, we really like seeing this number. It points to a healthy level of financial independence, meaning they aren't overly burdened by debt. All right, now we are going to prove that our unbreakable accounting equation really is unbreakable. Let's see how different transactions affect the balance. Scenario 1, purchasing $100 million in inventory with cash.
This increases one asset, the inventory, but decreases another asset, the cash. The net effect on total assets? Zero. The equation is still balanced. Scenario 2, taking out a $500 million bank loan. This increases cash assets by 500, but it also increases liabilities by 500. Balanced again. Scenario 3, the owner contributes $200 million. Cash goes up and equity goes up. Do you see it? In every single scenario, the dual effect of accounting ensures that assets will always equal liabilities plus equity. Section 3, the income statement, also known as Form B02DN. Remember our analogy from earlier? We are now putting down the snapshot and pressing play on the video. We want to see the company's operating, financial, and other performance over time. Reading an income statement is a lot like walking down a very specific staircase. You start at the very top step with gross sales revenue. Step 1, you subtract your revenue deductions to get net revenue. Step 2, you subtract the cost of goods sold to arrive at gross profit. Then, we factor in financial income and expenses, and we subtract operating overheads, like selling and administrative expenses. That brings us down to operating profit. Finally, we add in any other irregular profits, calculate the corporate income tax, and deduct that to reveal the ultimate bottom line, net profit after tax.
Okay, time to put your corporate detective hats on. Let's run the numbers for Ho-Bin's income statement. They generated $11,850 million in net revenue and had a cost of goods sold of $8,900 million. That leaves them with a gross profit of $2,950 million, which translates to a pretty solid gross profit margin of 24.9%. Eventually, navigating down the rest of the steps, they landed a net profit of $1,304 million. But I want you to pay close attention to lines 6 through 9, specifically those financial expenses sitting right there at $320 million VND. As careful analysts, you should immediately flag this. That is a substantial expense eating into their profitability. It's highly likely to be interest from those bank loans we noted earlier on the balance sheet, and it definitely needs close monitoring moving forward.
Section 4, the cash flow statement, or Form B03-DN. So why in the world do we need this third report? Well, because there is a very dangerous illusion in accounting. A company can show massive profits on paper in their income statement and yet still go completely bankrupt because of a severe cash shortage. The cash flow statement strips away all that accrual accounting to show us the actual hard cash moving in and out of the business. We categorize these cash flows into 3 distinct buckets. First up, operating activities. This is cash from customers and cash paid to suppliers and employees. You definitely want this to be a healthy, positive number. Second, investing activities. This is buying or selling fixed assets or lending money out. A negative number here isn't necessarily a bad thing. It actually often signals healthy expansion and investment. And third, financing activities. This is borrowing money, issuing shares, or paying dividends. The flows in this bucket can vary wildly depending on whether a company is in a rapid growth phase or if it's maturing.
Tracing Ho-Bin's cash using the indirect method reveals a really fascinating story. They started out with a profit before tax of $1,630 million. But remember what we just talked about. Profit is not cash. So we add back non-cash expenses, like $350 million in depreciation, and we adjust for changes in working capital. This brings us to a very healthy, positive operating cash flow of $1,424 million. After that, they spent $750 million net on investing, mostly buying new assets, and $500 million net on financing, paying down debts and distributing dividends. The net change is a positive $174 million, which, when we add it to their starting cash balance, leaves them sitting comfortably with $500 million in the bank at year-end. Which brings us to Section 5, Notes and Relationships, Connecting the Data. Now, the reports we've just analyzed are incredibly dense with numbers, but numbers without context, they can be wildly misleading. And that is exactly why Form B09, the notes to the financial statements, is an absolutely inseparable part of the reporting package. It is the narrative that actually explains the math. The notes break down into 6 key sections. They provide general entity information, they outline the accounting period and basis, and crucially, they detail the specific accounting policies being used. Are they using straight-line depreciation or accelerated, weighted average for their inventory? You'll also find detailed schedules, breaking down large line items, explanations of significant variances, like say, why revenues suddenly jumped 30%, and disclosures of events that happened after the reporting date. For example, if they signed a massive new equipment contract on January 2nd, you'd find it right here. And this brings us to what I think is the real elegance of the entire financial reporting system. These statements are all deeply, deeply interconnected. The video of the income statement
concludes with net profit, right? Well, that exact net profit figure flows directly into the snapshot of the balance sheet under retained earnings, which thereby increases equity. Similarly, the closing cash figure at the very bottom of the cash flow statement has to perfectly match the cash line item sitting at the very top of the balance sheet's current assets. It's like a giant puzzle coming together perfectly.
Our final section. Section 6, Applied Case Studies, Testing Comprehension. All right, class, it is time to put your analytical and synthetic thinking skills to the test. Let's see if you can diagnose some corporate issues using only the clues hidden in the statements. Case Study 1, the Profit versus Cash Paradox. Company ABC is reporting a robust net profit of 2 billion VND. Yet management is absolutely panicking because they cannot make payroll this month. How is this even possible? Take a moment. Think about what we just learned. Where would you look as a financial analyst? You need to immediately turn to the cash flow statement. Specifically, you want to look at their operating activities. It is highly, highly likely that their cash is tied up in massive uncollected receivables or sitting in a warehouse as unsold inventory. In short, their paper profits simply aren't converting to liquid cash. Moving on to Case Study 2, Interpreting the Balance Sheet. Company XYZ has total assets of $10 billion, total liabilities of $8 billion, and equity of $2 billion. That leaves them with a frankly staggering debt ratio of 80%. So if you were sitting there as a bank loan officer, would you approve an additional credit line for them? Answering this requires critically analyzing their financial independence. At 80% debt, they are heavily, heavily overleveraged. Unless they have guaranteed massive operating cash flows coming in, extending more credit to them is incredibly risky. Their capital structure is just far too fragile. And finally, Case Study 3, Performance Evaluation. Company DEF generates $20 billion in revenue with a gross profit of $2 billion. This yields a gross profit margin of just 10%. The catch? The industry average is 25%. So, as a manager, what is your next move? Well, first, you go straight to the income statement. A structurally low gross margin tells you one of two things. Either your pricing strategy is fundamentally flawed, or your cost of goods sold is bleeding you absolutely dry. You would need to aggressively audit supplier contracts, check your manufacturing efficiency, and drill down into direct labor costs to fix this structural defect. We're going to wrap up our masterclass explainer today with this thought. A person who cannot read financial statements is like a driver who ignores the dashboard. They may keep moving, but won't know when they run out of fuel. Financial literacy isn't just a party trick for accountants. It is the essential dashboard of business survival. I want you all to review these concepts and really practice those equations. Class is dismissed for today, but I'm going to leave you with this one question to ponder. If you were to pull the financial statements of your own employer right now, what hidden story would they be trying to tell you?